Good morning again, everybody. Welcome to Less Work, More Stock. Today, we're going to discuss and define an option. So, the term option refers to a financial instrument which is based on the value of the stock the option is purchased for. An options contract gives the buyer the opportunity to buy or sell the underlying asset. The holder of an option is not required to buy or sell the asset if they decide against it. Each options contract has a specific expiration date. The holder must exercise their option by the close of the market on that date. The price for which the option is purchased is known as the strike price. So the options can be bought and sold on any of these online brokers that you see down here. So you can go ahead, like and subscribe, pick one of these brokers, and go ahead and deposit some funds and start learning how to trade there. Put some questions down there, and we'll do our best to answer them for you. Um, let's. So what you got to know is the options are derivatives of the underlying asset that gives the buyer the right, but not the obligation, to buy or sell the underlying asset at an agreed upon price, and that is the strike price and date, and that's the expiration date. Call options and put options form the basis for a wide range of strategies designed for hedging, income, or speculation. These strategies can be very simple as buying an options contract for 50 cents and selling it for 75 cents, making what's that, 25%, 50% on your money, or buying it for 50 and selling for 25 and losing 50% of your money. So that's the simplest of the strategies. You could buy and hold the option and then exercise it to buy the underlying security. There are many opportunities to profit with options, but the risk of loss is immense because at expiration, if unexercised or sold, it expires worthless, $0. Um, Options contract involves a buyer and a seller. The buyer pays the seller a premium for the right granted by the contract. Options contract represent the opportunity to buy or sell 100 units of the underlying contract. Call options allow the holder to buy the asset at the stated price or the strike price within a specific time frame. Put options, on the other hand, allow the holder to sell the asset at a stated price within a specific time frame. Each call option has a bullish buyer and a bearish seller, while put options have a bearish buyer and a bullish seller. So it's all about expectation, folks. So let's break it down a little bit. Calls. A call option gives the buyer the right to buy the stock at the strike price or on or before the expiration date. A call option, therefore, becomes more valuable as the stock rises in price. As the option increases, and the holder can sell the call option to another individual or exercise the option on or before the expiration date. A long call option can be used to speculate on the price of an underlying asset rising, since it has an unlimited upside potential, but the maximum loss is the premium paid for the option. Puts, opposite to call options, gives the holder the right to sell the underlying stock at the strike price on or before the expiration date. A put, therefore, is a short position on the underlying security. You expect the price to fall. And since the put gains value as the underlying security's price falls, they have a they have a negative delta. And Greeks are something that we'll discuss in the future. Um, so puts can be used as a sort of insurance, providing a price floor for investors to hedge their positions. So here's what you need to know. Options contracts usually represent 100 shares of the underlying security. The buyer pays a premium fee for each contract. For example, if the option has a premium of 50 cents per contract, buying one options costs $50. That's 50 times 100, 50 cents times $150. The premium is partially based on the strike price or the price for buying or selling the security until the expiration date. I'm sure there's a ton of math that goes into that, and we're not going to concern ourselves with that at this stage. We just want to understand what an option is. Another factor is in the premium price is the expiration date. Just like that milk of carton in the refrigerator, the expiration date indicates the day the option contract must be used by. The underlying asset will also determine the use by date. So those are the basics of options. To break it down even further, say you think that Apple is going to go to $150 in November, and you want to place a bet on that. So you go ahead and buy some November call options for Apple, $150 strike price, and November 30th expiration date, or whatever day they're selling options for, Apple options for in November, with the expectation that the value of that option is going to rise along with the stock price. If you thought that Apple might be down to $130 in November, then you'd buy puts on Apple and hold those puts. As the value of Apple's stock decreases, then the value of your puts would increase. So those are the basics of options, folks. Like and subscribe, ring the bell so you don't miss any notifications, and go ahead, download one of those online trading platforms, and let's get to it. Less work, more stock. That's what we're here for. You guys have a wonderful day. I wish you all the best.